Investing can be an intimidating prospect, especially for those just starting out. With so many options and strategies available, it's easy to feel overwhelmed and make mistakes that can have long-lasting consequences for your financial future. One of the most common mistakes that new investors make is failing to understand the importance of diversification. In this video, we'll explore what diversification is, why it's crucial, and how you can avoid this costly mistake. What is diversification? Diversification is the practice of spreading your investments across various asset classes, industries, and geographical regions. The idea behind diversification is simple. By not putting all your eggs in one basket, you reduce your overall risk exposure. If one investment performs poorly, the others in your portfolio can potentially offset the losses, helping to minimize the impact on your overall returns. Why is diversification important? There are several key reasons why diversification is essential for successful investing. 1. Risk mitigation. Different asset classes, industries, and regions tend to perform differently under varying economic conditions. By diversifying, you reduce the risk of your entire portfolio being adversely affected by a downturn in a specific sector or region. 2. Potential for higher returns. While diversification doesn't guarantee higher returns, it can help you capture gains from various market segments that may be performing well at different times. 3. Balanced portfolio. A well-diversified portfolio can help you achieve a balanced risk-return profile that aligns with your investment goals and risk tolerance. The mistake of not diversifying. Many new investors make the mistake of concentrating their investments in a limited number of assets, often based on familiarity, hype, or personal biases. This lack of diversification can expose them to significant risks and potential losses. For example, imagine an investor who puts all their money into a single stock or sector that they believe has tremendous growth potential. While this strategy could pay off handsomely if their predictions are correct, it also carries a substantial risk. If the company or industry experiences a downturn or unexpected setbacks, the investor could lose a substantial portion of their investment, if not all of it. Real-life examples. History is replete with examples of investors who suffered significant losses due to a lack of diversification. 1. The dot-com bubble. During the late 1990s and early 2000s, many investors poured their money into technology stocks, believing that the internet boom would continue indefinitely. When the dot-com bubble burst, investors who had concentrated their portfolios in tech stocks saw their investments plummet in value. 2. The housing market crash. Similarly, in the mid-2000s, many investors heavily invested in real estate and mortgage-backed securities, assuming that the housing market would continue to rise. When the housing bubble burst, these investors faced devastating losses. How to diversify your portfolio. Achieving proper diversification involves spreading your investments across various asset classes, such as stocks, bonds, real estate, commodities, and alternative investments. Within each asset class, you should also consider diversifying across different industries, sectors, and geographical regions. Here are some strategies to help you diversify your portfolio effectively. 1. Asset allocation. Determine an appropriate asset allocation based on your investment goals, risk tolerance, and time horizon. A common approach is to divide your portfolio among stocks, bonds, and other asset classes. 2. Index funds and ETFs. Consider investing in low-cost index funds or exchange-traded funds, ETFs, that track broad market indices. These funds inherently provide diversification across various stocks or other assets. 3. Sector and geographic diversification. Invest in different sectors and industries, as well as in different countries and regions. This can help mitigate risks associated with specific markets or economies. 4. Rebalancing. Periodically review and rebalance your portfolio to maintain your desired asset allocation and diversification levels. 5. Seek professional advice. If you're unsure about how to construct a well-diversified portfolio, consider seeking advice from a qualified financial advisor who can help you develop an investment strategy that aligns with your goals and risk profile. Conclusion: diversification is a fundamental principle of successful investing. By spreading your investments across various asset classes, industries, and regions, you can reduce your overall risk exposure and potentially enhance your chances of achieving long-term growth. Failing to diversify is a mistake that many new investors make, often with costly consequences. Remember, the key to effective diversification is to avoid putting all your eggs in one basket. By embracing diversification from the outset, you can increase your chances of achieving your financial goals while navigating the inherent risks of investing.